Our next speaker is calling in also, but a bit nearby. I don't know where that's going to be matter about the techniques, but it's Robert Secker. He's a portfolio specialist at Rowe Price. Robert is calling in from London, and he will guide us through the Chinese equity market, which he calls a stock picker's paradise. Robert, a stock picker's paradise, that sounds very promising. Please explain. Well, you're going to do that in your presentation, of course, but that sounds very good.
Well, first up, thanks very much for having me. Sorry I can't be there in person to talk to you today. I think my compliance department would run in through that door if I said it is a promise that China is a stock picker's paradise. What I mean by that when I say it's a stock picker's paradise is the dynamism of the economy, the dynamism of the market, the dynamism of management teams and the corporate sector, allied to an investor base that is very retail driven, a market that is inefficient, means as an active investor, you've got a massive market with a massive amount of opportunities. And we've got a slide somewhere in the deck that shows that active management in the Chinese market can pay off handsomely. So therein lies my rationale for claiming China to be stock picker's paradise.
Okay, thank you. Well, please start with your presentation if you like to.
Okay, I believe you're sharing the slides, eh?
That's correct, but some of the slides might be detailed, and it's good to talk us through them.
Yeah, if you could move on to the third slide, so just past a few of the images. So I guess what I'd like to try and convey with my presentation to you today is we believe the Chinese economy is incredibly dynamic. It is an economy that is constantly changing, constantly evolving, and that change gets reflected quite quickly in the equity market, and therein is the opportunity. Now, the fact you guys are all attending a China conference today means this slide is pretty much redundant. But in essence, the message I'd like to get today is that China at the start of this century was insignificant. It didn't really matter from an economic perspective, and it certainly didn't matter from a market perspective. Where we are today and where China has grown economically over the past 2 decades is such that China is the world's second largest economy. It's almost the equivalent in size of the next 5 largest economies in aggregate. What happens in China today matters. And of course, you guys know that because you're dialing in to this conference today. So what matters when we think about China and the Chinese economic picture? Well, the next slide talks to that, and it talks to how exports are a large part of China's success story, China's rise in prominence. If you could move on to the next slide. You can see that China started, there we go. China started to really begin to export its way into the central ground of the global economy. The catalyst for that, of course, was China joining the World Trade Organization in 2001. They did so with a massive labor force, a labor force that was very cheap, a country where people were moving to the cities, and they cemented their place as the low-cost manufacturer. They've subsequently grown through this period of time to become the world's largest exporter. The nature of their exports has changed. It's become much more value additive through the manufacturing process. But the message is China is integral to global supply chains that are very, very difficult to unpick. But when we look at the makeup of China's economy, net exports don't really matter within the economic situation. What is the key driver of China's economic story, its economic growth profile, is consumption. And if we can go back to the slides and move on to the next one, we can look at, so if you go on to one more from that, we can see that the Chinese consumer is a consumer that's getting wealthier. This shows disposable household income within families in Chinese urban areas. About $9,000 per year they have available to spend. That's doubled over the past decade. That means consumption patterns are changing, what they consume is changing, and as we've heard from certainly the previous speaker, maybe previous others, the medium by which they consume is changed as well. It's gone much more to an e-commerce environment, and they kind of missed out on the whole retail shopping experience that we in the West certainly know, and certainly my wife enjoys. Is myself a very different situation. But the next picture, if you could go on to, I think you've got the world's largest population, a population where people are getting wealthier, but a population where people still save a lot of their money. And they save a lot of their money because you don't have the same pension systems in place. Healthcare is more expensive. Education is more expensive in China. If you look at education and healthcare spend in aggregate, it's normally been about 20% of total Chinese population's expenditure. Big ticket items, which is why the government are looking to tackle those particular parts of the environment today. But the message there is, can you, yeah, there we go. I may be closer than the previous speaker, but technology clearly isn't any better coming from London.
You have to move a lot to get the light working, I presume.
You can't get too much light working when you don't have much hair. You get far too much reflection. But one of the messages on China is they save a lot of money, right? And they typically save about 30 to 40% of that disposable income has been saved away. And we think that is going to increasingly get put back into the market. People are going to use that to try and buy more products, and they're going to be able to do so because of some of these regulatory changes that the government are putting in place. And that provides huge opportunities. It provides opportunities for companies that are benefiting from import substitution. It provides opportunities in insurance, wealth management, a whole myriad of new industries that will benefit from Chinese consumers beginning to spend more than they are saving. And if we can move on to the next slide, if possible.
Robert, just a question here. Why would they start spending the money that they have been saving so far? I mean, wouldn't they use that all for their retirement? Or is that the moment that's arriving, so they're going to spend it?
Well, I guess there's a number of things at play there. So we've read an awful lot about the regulatory cycle that's taking place within China today. And part of their motivations are to make it a more equal society, to really tackle the disparity between the haves and the have-nots. And they've gone after two parts of the economy, after school, education, tutoring, and healthcare. And as I say, these were pretty big expenditure items for typical households within China. Healthcare costs are coming down dramatically. They've essentially banned or outlawed private tutoring, private education system. So that in itself gives families more capital to spend to start consuming. You've also had a declining birth rate as well. So you have what are called, I guess, a lot of dinkies, dual income, no kids. Those people with a whole array of disposable income that they don't need to put to one side. So we think there is what we consider a lot of dry powder. And yes, you're right, some of this will go into savings products for pensions, but that will start to improve the wealth management industry. It will be a real driver for equity markets, for saving products. So the message is that the situation will continue to change. Consumption will continue to increase, and methods and means of consumption and what gets consumed will continue to change as well.
Okay, thank you. Thank you.
So if we can go back to the slides and see what the next one was, because it talks to change. And really that is the main point that I would imagine you'll take away from attending this conference today. And this slide just looks at a couple of points showing the situation in China in 1990 and the situation in China where we are today. Some simple stats: number of cars, number of fridges, number of graduates, number of people that live in cities. Now, to quote a stat from a review that was done by Harvard Business School, they looked at lifetime change index, and they have seen that if you are living in China over the past 30 years, your GDP per capita has gone up 30 times, not 30%, but 30 times. So you've got people in China that are 40 to 50 years of age, where their experience today is unbelievably different from what it was in their childhood. That means people in China are very adaptive. They like change, they're innovative, and that really does manifest itself in the equity markets and in the corporates that we're seeing and the management teams that are running these businesses within China today. And a stat there that I think is key to China's future success lies in the number of university graduates today. There are more science and engineering graduates in China coming out every year than in any other market. And that will really be a driver of China's future economic success. So that wraps up my bit on hopefully giving you a flavor of why we're excited about the Chinese economic situation. But I'm here talking about the equity markets, and what happens in an economy is only exciting if it's investable and if it is being reflected in the equity markets. And that's what the next section of this slide deck would talk to. If we can move on to the slides again. So if you move on another, I think the previous speaker spoke to that and how China is underrepresented in capital markets relative to its economic size. I think we all know that. I think this is an interesting one to frame the dynamism of China's equity markets. So the chart there on the left-hand side, looking at the number of stocks within the Chinese stock market. The start of this century, there are 1,000 listed companies in China. Today, it's over 5,000. There are now more listed companies in China than there are in the US equity market. And that change, that growth in the opportunity set is shown there on the right-hand side, looking at how the composition of that market has changed as the number of companies coming to the market has changed and has grown. So this plots the sector weights within MSCI China in 2010 along the horizontal and 2020 on the vertical. So if you went back 10 years, China was a top-down market. It was about financials. Financials were 40% of your benchmark. It was about energy. It was about some utilities. It was about telcos. Where we are today, it is much more about the innovative areas of the market, the consumer-orientated areas of the market. IT is now about half of the opportunity set. China is much more akin to the US market today than it certainly was in the past. And it's that changing nature of China, which I believe is the opportunity. And that's why China is the stock picker's paradise that we spoke about at the outset of this presentation today. So let's drill in a little bit more detail on the Chinese market and the Chinese universe as well, because I don't feel the universe is fully represented and captured in China indices. The Chinese index is not a good reference point to getting exposure to the opportunities that China presents. And if I could ask you to pull back up the slide deck and move on a slide. So move on to that one there. That's perfect. So we've got over 5,000 companies in our universe. The chart, the column on the left looks at the number of companies in the entire universe. The top 100 companies, by a stock count perspective, it's a couple of % of our opportunity set. Yet you look at the middle bar there, those 100 companies account for 2/3 of the Chinese index today. At the start of this year, two stocks, Alibaba and Tencent, were almost 30% of the Chinese index. The index is not a good reference point to the opportunity set when you're thinking about investing in China. Yet too often the opportunity set, too often the index is a reference point for investments and investors. And you look there on the right-hand side, the average China fund has sort of benchmark type allocation to those mega caps. To us, that means there is a whole part of the market, a whole part of the opportunity set that is underrepresented in the index, underrepresented in peer funds, undercovered by sell-side brokers, very inefficient, and a hotbed of innovative businesses that can move to become some of the largest mega caps within the Chinese market. The next slide, if you look at it, shows the composition of the market by share class type. And when you invest in China, as we know, it's like an alphabet spaghetti sort of situation. You've got A shares, you've got ADRs, you've got H shares, you've got P notes, you've got B shares and such like. But A shares are by far the biggest opportunity within China today. These are onshore equities. They dominate the universe, yet similar to the previous chart, they are not really punching their weight in the index, and they are not really reflected and captured in our peer group opportunity set. So again, the message there is that a whole part of what is exciting about being active, getting exposure to China, isn't available, isn't there in a passive exposure, in an ETF, in a beta. And in many instances, it's not properly reflected in investment products either, in some of the largest China funds out there. So if we can move on to the next slide, and a couple more points, and then we'll kind of take questions. So why is the A-share market exciting to us? Well, frankly, it is possibly the least efficient market out there, right? When you look at the Chinese market, it's a market that is dominated by a retail investor base. And that's what the chart there is showing you on the left-hand side. Retail investors account for about 80% of all of the turnover on the A-share market. And their holding period is myopic. They are so short-term in nature, you can't even really call them investors. They are speculators. They buy stories, they buy themes, they buy momentum. And their average holding period is about 17 days in aggregate. That means if you come to that market with a different mindset, a different time horizon, some fundamental rigorous analysis, you can really exploit those inefficiencies. And we've seen a rising participation from foreign investors in the A-share market, but it's still only about 4.5% to 5%. We think that will increase materially in time. The Chinese government are doing many things, but one of the things they are doing at the moment is opening up their capital markets to international investors. It's another case in point whether international investors want to access the Chinese market, but it is increasingly accessible to international investors. And as more and more institutional investors gain access to the Chinese market, you will see improvements in all sorts of metrics on a governance perspective, on a disclosure around environmental, social factors. But for the time being, it's a market that is deeply inefficient and a market that many foreign investors haven't really spent much time investing in. So it's a huge opportunity to be active, take a different side of the argument to that retail investor base and exploit their short-termism. So if we go back to the slides, and maybe I think it's possibly worth just running on to the concluding one and then take some questions. So I'll stop on that one. If you go back to the alpha opportunity, the previous slide, we'll end on that one. So this is why China is a stock picking paradise. This looks at the performance of funds in the Morningstar category and looks at the outperformance of the median manager versus the benchmarks there. So the median manager is that circle. So across all time periods, your median manager is outperforming the benchmark. And that is your median manager. That is not even your best manager. So if your average manager can outperform, for those that are above average, good, better, fantastic, the opportunity there for alpha is enormous. And that's something that I think really needs to be investigated and exploited. And I'll leave it there, and we can move on to some questions.
Yes, there are some questions. I have a question by Peter Kaneveld. Is the beta of the Chinese equity markets correlated with global equity markets? In other words, is Chinese equity a separate asset class or a country play?
It depends which part of the market you look at. If you were to look at those Chinese equities listed in the US or listed on Hong Kong, they're much more of a beta play than those onshore equities, the A-share market. So the A-share market is possibly one of the least correlated to global markets. But China in aggregate, when you look at MSCI China, and as we showed in some of those charts, it is more exposed to H shares than A shares. So it is still somewhat of a beta play on global markets. But I think what you've seen over the past couple of years suggests that it is different. It does behave differently. China was one of the best performing markets last year. It was the best performing economy. This year, it's one of the worst performing markets, right? The issues taking place within China last year were very China-centric. The issues taking place within China this year are very China-centric. So yes, of course, equity markets, it does have a positive beta, but it is perhaps relatively low compared to other markets out there. It is a very, very domestic market. The overall Chinese market, 85% plus of revenues are domestic in nature.
Okay, thank you. Any questions here? There's several questions here in the room. Do we have a microphone?
Thanks for your presentation. Would you favor any specific investment style when looking at China?
The only investment style that I would say, and admittedly I'm here representing an active fund management house, so I have to say it, otherwise I will be shot. But active management within China really is the way forward, right? For all of those reasons about the inefficiencies, the shareholder base in the A-share market. I think you need to be active. I don't think you have to pigeonhole to a style of growth or value. I think you just need to be fundamental. You need to be bottom up. You need to be selective, because the market is such that it provides opportunities on the growth side and it provides opportunities on the value side as well. It is just a market that rewards active investing.
Thank you. I think there was another question in the back.
Yes, hello. I wonder, whether the extent you can be successful in China when it concerns investing in companies is as long as the government doesn't step in. Like if a company becomes too successful, makes too much profits, then the government steps in, and it will be hard to retain those returns, maybe in this company.
No, you're right, and that is, I guess that's the reason why China is increasingly being thought of as a standalone investment opportunity, and perhaps why its beta is a little bit low, because China behaves very differently to other markets. So you are right that there is always the threat of government intervention. But what we would say is that you tend to see it fairly well signposted about the areas that the government is going to look at. So when you think about how China has transformed itself over the past couple of decades, what tends to happen is an industry starts to build, starts to evolve, starts to become more important. And it's only once the industry is established and quite significant in size that regulation then comes into it. So the regulation is more backloaded when operating in China. And you can tend to see where you think that area might be under threat. So we're all reading about Evergrande and the property segment at the moment, right? That has been in the crosshairs from the regulators for a number of years now. They've been targeting the over-leveraged companies and property developers. So you can avoid that. Healthcare is a sector that's been looked at for 3, 4, 5 years as they look to drive down the pricing. I think the mechanism is the means that catches people unawares rather than it being the sector. Tencent has been looked at before down the years. I think the mechanism and the fact China will go in and they'll make some significant changes almost overnight, that is the threat. And yes, you're right, it will mark down the profitability for certain companies. But as I say, you can tend to highlight which segments of the market are going to be targeted before they are targeted. So you can begin to reduce your exposure to those areas of the market. And let's not forget, it's an enormous universe, and there have been companies that are benefiting from this regulatory crackdown, right? So Alibaba's profits are going to come down over the next couple of years. That's undoubtedly true. but it provides opportunities for JD, it provides opportunities for PDD, it provides opportunities for companies that sell their products via Alibaba. So that is the message, really, that yes, you're going to get these risks. A lot of them are signposted. And for every company that is going to be suffering because of government policy, there will likely be companies that are winning on the other side of that equation.
Okay. I have another question here from an online viewer. It has to do with investment strategy, I think. Many investors hold their China shares through ADRs in the USA. Is this still a good idea, or should one buy at the Hong Kong exchange?
Okay, it's a question we get a lot, and it's an area that we've spent a lot of time looking at internally. And let's start with the conclusion. It doesn't matter. When you look at the ADRs, and there is the threat of delisting, but what's happened is Hong Kong have changed their listing requirements to make it incredibly easy now for those companies listed in the US via ADRs to relist in Hong Kong. So what you've seen now is most of those, not all, but most of those ADRs now also have a dual listing in Hong Kong. The shares trade kind of pari passu, they're fungible, to use some words that probably don't necessarily translate that well into Dutch. But in essence, it means there's no risk. If they were to delist from the US, you would continue to be able to trade those shares and own them just on the Hong Kong exchange. And when you look at trading volumes, people are continuing to trade the ADRs. They're not trading via the Hong Kong dual listing. So the market is speaking with its feet, and they're not concerned about it at all. So they're continuing to own the ADRs.
Okay, thank you. One very last question, because we didn't really touch upon that, and it's a major theme in this week, the week of the Climate Week. How about ESG? You didn't mention it. Where does that come in your stock picker's paradise?
Well, I guess there's a reason why I didn't mention it, and that was the length of my time slot, right? I only had 20 minutes. Okay, you could spend a day chatting about ESG.
You have 1 minute for the answer.
So I'll bring ESG down to a company level, because that's what we're looking at. We are bottom-up investors. It's about being active, about engaging with management teams. When we look at ESG, we look at ESG in China the same way we look at ESG in any other market. And we don't see that ESG practices in China are noticeably any different from anywhere else on the globe. Where we do see a difference is in their level of disclosure. So they may be operating well, but they aren't disclosing well. And I think as you get more and more foreign investors into this market, the disclosure levels will come up. So we see ESG at a bottom-up level, broadly speaking, is good, it's okay. Increasing dialogue with companies will improve the disclosure. And sorry, I think I've just timed out. My minute's overrun, something popped up. So there it is. The summary is ESG in China is something that we don't approach any different to any other part of the market globally. Okay. It's integral to bottom-up investing.
Thank you very much. And hopefully next time we'll meet you in person. Thank you very much, Morat.
Pleasure.
Thank you.
Thank you.